Let's start our refresher by looking at cap rates. What are they and how are they calculated? First, the ratio itself is pretty simple. The cap rate is equal to the net operating income divided by the market value. In one of my previous posts, I discussed a property with a net operating income of $210,000 and a purchase price of $1.5 million, resulting in a cap rate of 14%. Now, we can use that same formula to estimate the value of a property by simply rearranging the terms algebraically and solving for the value. That's all I've done here. The value of a property is equal to the net operating income divided by the capitalization rate, cap rate. In this case, considering the exact numbers, if the net operating income is $210,000, then by dividing it by a cap rate of 14%, the value is approximately $1.5 million. As you can see, the numbers are related, but we need to add some clarifications. Let's review the definition of cap rate, or capitalization rate. Capitalization is the process of converting future income into value. The method of gathering data to determine the cap rate is more complex. The process begins by collecting data on the sale of all income-producing properties, generally within a specific geographical location. And then, from that data, the net operating income and the sales price of those various sales are used to compute the capitalization rate for each sale. When the appraiser or the investor wants to generate an estimated value of a property, they will use the cap rates of comparable sales to derive the estimated cap rate. This will become clearer in a moment. It is that rate that is used to estimate the value of a subject property. For instance, let's look at this. Let's assume the data indicate that 10,000 square foot retail strip centers in the San Fernando Valley area of Los Angeles, built in the 1960s, are trading at a cap rate of 8%. If the pro forma net operating income of the subject property is estimated to be $240,000, let's convert that to value. The value of the property is calculated as follows. Take the net operating income of the property and divide it by the capitalization rate. $240,000 is divided by 8%. The estimated value is $3 million. This calculation is straightforward. There are several other issues that we need to address. Because the cap rate is market-derived, it also has its limitations. Various methods can be used to calculate cap rates. One of the concepts used is the concept of bands of investment, and there are many others. I won't go over those now. They all seem to be academically pleasing. You end up with a number that seems to work well. However, it's unclear whether this approach yields better results, and I think that it doesn't. If the average investor does not understand it, I'm not sure it should be used. When using cap rates, several factors need to be considered. First, the age of the property. The older the property, the more likely it is that an investor will pay less for each dollar of income. Why? Because it has a shorter economic life remaining. The amount that is paid for each dollar of income will be less. Also, the cap rate depends on the quality of the leases. If you're dealing with national credit tenants, there's one price that will be paid for each dollar of income. If you're dealing with tenants of lesser quality, the price will be significantly lower. The fewer quality tenants, the higher the cap. Additionally, occupancy is a factor to consider. If the property being acquired is not fully occupied, many appraisers or investors calculate the stabilized income of the property and use it to estimate the value. They then make specific adjustments to that value based on the length of time it will take to rent up the property, as well as the expenses associated with leasing commissions and tenant improvement work. Deducting those from the value, it sounds good, but again, there are more limitations on cap rates. The problem with cap rates is that they rely on a one-year investment model, and this has inherent limitations. If the investment has uneven cash flows, the model is just unreliable. I'm not sure it can be used. In these cases, the analyst will likely calculate the stabilized cash flow and then make adjustments, as we've already discussed. There is another approach, which involves calculating a risk premium and adding it to the cap rate. The cap rate is likely best used for taking an initial look at a prospective investment. If that investment passes that initial test, then the best practice would seem to indicate that you should probably complete a discounted cash flow analysis, a multi-year analysis, if you will. That will likely yield the most reliable results.